Welcome back to Pest Control Unlocked. I'm your host, Konstantin Schwartz. We often talk about the industry giants, Anticimex, Rentokil, Rollins, Ecolab, and it's easy to focus heavily on their strategies, their cash flow, and their expansion models. But if we only watch the giants, we risk missing something that is just as important: what's happening underneath the surface of the market. Because right now, in early 2026, the pest control industry is experiencing a significant shift, not just operationally, but financially. If you've been following recent coverage in PCT and PMP magazines, you'll have noticed one thing: M&A activity is accelerating. But this isn't just another active cycle. There are deeper forces at play. The first question we should ask is simple: why now? Why is capital flowing into pest control at this level? There are a few key drivers. First, pest control is fundamentally a recurring revenue business. In the US, roughly 70 to 75% of revenue is contract based. That's extremely attractive to investors looking for predictable cash flows. Second, the industry remains highly fragmented. There are still close to 17,000 operators across the US alone. Third, we're operating in a market where organic growth is increasingly constrained by labor. If you want to grow, you need technicians, and technicians are harder to find, train, and retain. So instead of building growth organically, capital is increasingly buying growth through acquisition. Private equity needs deployable capital. Strategic buyers are looking for scale. And pest control sits right at the intersection of stability, growth, and fragmentation. So who are the buyers? We're seeing two major domestic groups become incredibly active. On one side, you have private equity-backed platforms, firms like Thompson Street Capital Partners backing Pesco Holdings, or Halley Capital supporting Rocket Pest. And increasingly, platforms like Certus are building scale rapidly across multiple states. Certus is a particularly interesting example. They are not simply acquiring revenue, they're actively building density in specific target markets. They centralize the back office functions like billing, routing, and HR, but they intentionally preserve the strong local brands that have been built. That combination, scale behind the scenes but local strength in the field, is becoming the blueprint for value creation. On the other side, you have established family-owned operators expanding their footprint. Companies like Arrow and Massey continue to grow regionally alongside global players like Rentokil, who are continually optimizing their network. But what makes this moment particularly fascinating is the role of international capital. Since we have listeners tuning in from all over the world, let's look at how global investment is split into two very distinct strategies right now. European investors are focused almost entirely on acquiring service routes in the US. You see this with the Norwegian-backed Tyro Group making their recent move into Texas, alongside Swedish firm Anticimex steadily building density across North America. Their strategy is clear: acquire the customer relationship, build route density, and scale the service network. Asian capital, however, is playing a completely different game. Rather than acquiring local service businesses in the US, Asian investors are primarily consolidating their own rapidly growing domestic markets across Southeast Asia, China, and Japan. When Asian capital does enter the US market, it tends to focus on upstream capabilities: product manufacturing, chemical innovation, and intellectual property. A classic example is Japan's Sumitomo Chemical taking a majority stake in MGK. So the contrast is quite clean. European capital is buying the service layer, Asian capital is investing in the technology and supply layer behind it. Now, let's talk about valuation, because ultimately, that's what this is all comes down to. Depending on quality, scale, and structure, pest control businesses today are trading across a fairly wide range. Smaller operators with less structure may trade at mid-single-digit EBITDA multiples, but high-quality businesses with strong recurring revenue, dense routes, and clean financials can command double-digit multiples. The difference between those two outcomes is not luck, it's structure. If you listen to the advisors who help structure these deals, like PCO bookkeepers and M&A specialists, they will tell you buyers are scrutinizing your numbers against benchmarks like the William Blair PCO Pest Index. They are looking for four key things. First one is revenue quality. They want predictable, contract-based income. The second is financial clarity. Clean, structured, transparent books. The third is around customer metrics, strong retention rates, predictable acquisition costs, and solid conversion rates. And the fourth is around route density. As Paul Gianamore and the team at Potomac Mergers and Acquisitions constantly highlight, it's not just how many customers you have, it's how close together they are. Dense routes mean lower drive time, higher productivity, and significantly improved gross margins. Just as importantly, buyers actively avoid messy financials, low contract penetration, scattered routes, and high customer churn. These issues don't just reduce value, they can stop a deal entirely. So, what does all of this mean if you're running an independent pest control business today? It does not matter whether you plan to sell or not. The implications are the same. The market is raising the standard. If you want to build lasting value, you need to know your numbers by channel, tighten your routes to build density, and improve your speed to service. But how do you protect your margins when larger, well funded networks move into your area? Your biggest advantage as an independent operator is agility. You can adopt new pest technologies and software much faster than a massive corporation that is bogged down by layers of approval and legacy IT systems. Let's look at what that actually means on the ground in 2026. First, consider AI driven route optimization. We aren't just talking about basic GPS routing anymore. Modern pest control software dynamically adjusts schedules based on live traffic, appointment windows, and specific technician certifications. Industry data shows that intelligent routing can cut drive time by up to 30% and increase daily job completion rates by 25%. If you run 5 trucks, that is a massive increase in billable capacity without hiring a new single technician. Second, there's a rapid rise of the Internet of Things. Smart traps and remote monitoring sensors are completely changing the game, particularly for commercial accounts. Instead of sending a technician to check empty rodent stations, sensors provide real-time alerts the moment there is activity. This allows you to shift from a reactive schedule to a predictive one, reducing unnecessary service calls and lowering your labor costs. Third, think about the customer experience. By implementing automated customer portals, digital quoting, and seamless online payment systems, you create a level of frictionless, premium service that large networks often struggle to replicate at a local level. When you combine a smart routing, IoT monitoring, and a seamless digital customer experience, you build a highly profitable, incredibly sticky business. Over time, this wave of consolidation will reshape the industry. We will likely see a cleaner divide between high-performing operators and the rest. But remember this, consolidation doesn't remove opportunity, it raises the bar. The companies that win won't necessarily be the biggest. They'll be the ones that understand their numbers, control their destiny, and deliver an exceptional level of service. Because in the end, buyers don't pay for size, they pay for quality, predictability, and control. And the better you understand that, the more options you'll have, whether you decide to sell or not. That's it for today's episode. Thanks for tuning in to Pest Control Unlocked. My name is Konstantin Schwartz, and thank you very much for listening.